Tom, we have a couple questions.
Oh, good. Questions. Thank God. $25 chip for you, too.
Adam told us to find the gaps and cover them. And as far as our plans are concerned, yes, we can search through those. We can find all those holes and cover them. But what forms a laser is something that's in the plan already that we are covering, and it's a gap that we have to find out. And that's one of the things that I'm concerned most about in our plan is, what if I'm hit with an unusual laser? My question for the panel is, would any of you consider offering a carve-out so that ahead of time I could pay a small premium each year and we could spread it across the group, and eventually, if we are hit with the laser, the carve-out would take care of that, just like anything else. And the idea would be that since most lasers, and I've had two on us, and we've paid $0 towards either of those lasers, so many of them don't come to fruition, but it would be an opportunity for us to cover ourselves in the future and stop a gap that could be there.
Well, I think that we referred to this just a little bit ago, but there are policies that we offer, which is called a no laser contract, and you pay a little premium up front to limit your exposure in future years. In our scenario, you pay a 10% surcharge, and we limit your rate increase in the coming year to a 50% increase, regardless of the conditions. Now, I will tell you, just the basic nature of claims cost, if you end up with a hemophilia diagnosis or something along those lines that is $1 million a year, over time, you're going to have to look at a situation where you're sharing a cost.
And there's one option too that we have and I'm not sure if this is what you're referring to or not, but we have a organ transplant carve-out policy. So that is a supplement to your self-funded plan. So if that's what you're referring to, there are those out there that we have one of those as well.
Is there a size group that's appropriate, or is there? Let me ask it different. For the organ transplant carve-out coverage, how big should you be in order to buy that, or is there a point at which you become too large and the premiums just aren't worth it?
Interestingly enough, the minimum lives for our stop loss and our transplant product is the same. It's 50 lives, so it does go down pretty small. Generally speaking, I'd say that the sweet spot is probably 50 to 1,000, but that's not to say that there aren't groups that are bigger than that have the product. Our largest client has 20,000 employees and has a transplant carve-out product.
How much premium are they paying on that?
A lot.
Yeah. It seems to me, I mean, again, in our experience, that the bigger the case gets, the more difficult it is to justify the cost of organ transplant.
Yeah, you can get to the point that your spec is going to be, or actually, I think it's that if there is some sort of laser that's involved, the larger client, if you have a $500,000 laser for a 60 life group, that's a big hit. That could be double their expected cost for that year. If you have a 700 or 1,000 life group, for them to have that additional couple $100,000, it's not as bad, so they don't really seem to see the need for it. And it usually, as the specs go up, and a lot of carriers, us included, will give you a discount to your stop loss if you put this product in. And usually with the higher specs, that discount tends to lessen because of the group spec is so high and it's such a bigger group.
Yep. All right. Holly, was there another question? Oh, there's a couple of them. You're not running, Holly. You need to run. We're limited in time here.
So I have a question. We're in year 2, going into year 3 of being self-funded. What advice would you give to a group that potentially has a very, stubborn CFO that insists on budgeting to max cost? What advice would you give for budgeting? Because I think one of the challenges that we're facing is that it's hard to actually see savings as a result of the way we're budgeting. Does that make sense?
Can I ask you how many employees are in the plan?
250.
Okay, so you're going into your 3rd year. I think your CFO's being very prudent. I'm not sure I would sit in the same seat, but I think to really get a picture on the ebbs and flows of what could happen in a self-funded plan, you need 5 to 7 years to really figure that out. And so I don't think that's a wrong tack to take until you really because the old adage in this business, old from 1970s anyway, is that every 5 years you're going to have that adverse year.
Right.
And so you want to have 5 to 7 years before you can figure out where that mean is. And that would be the advice I would say. Just put up with him a few more years, and then you probably have some data to, knowledge is powerful. So when you have that data, you can go back and say, hey, this is when you average this out, it's been this much. Why we just back off on the funding a little bit, or
Right.
the reserving.
Just a little piece of data for you. Most of us have all of us have a sizable block of stop loss that we can actuarially predict where our business ends up at the end of the year, and we track that. On an average group for my company and most companies up here from a claim side, right, anywhere between the 78 and 82% loss ratio. That's what we refer to as expected claims.
And what's your loss ratio with Cypress?
48%, and I ran it on the way out here. 48% net. But on the claims pick side, the aggregate side.
Thank you. Thank you.
So if you're looking to budget at expected claims, outside of that year every 5 or 6 years where you have that large claim pop up, on an average year, 78 to 80% loss ratio is actuarially predictable, pretty much, for a group of 150 to 200 lives.
Thank you.
A couple of observations about that real quick. Number one, we deal with a lot of municipalities who are pretty much obligated to budget to the maximum. And it seems to work well for them. But that being said, it's not, especially with small employers, it's not just budgeting to the maximum, but it's actually funding it to the maximum. And it's one thing to budget because that's all on paper, but what's in that bank account?
And we have tomorrow in our client panel, one of our panelists is going to discuss the amount of cash reserves they've accumulated over the years by funding to the max. So you'll be interested in hearing that. John.
For several years, the challenge that when we all got together and talked was how do we get competitive against fully insured on the smaller groups without the access to the good claims data. And I think we've made a lot of strides and are getting a lot more competitive. And I agree with the comments that first year out of the chutes, coming out of fully insured, it should be a 12-12 and then move to a paid contract. But my question is related back to what was said, that you start out with a 12-12 and you got to make sure that the employer understands that they'd be moving to a paid, and there is adjustments to rates and factors at that point in time. What do we need to do? This is just an open question for anybody up there. What do we need to do to get competitive on those kinds of cases with a mature contract, even if we're selling a 12-12, so that we're not so that we can show that we're competitive on those contracts against the fully insured in the first year, even though we're taking a 12-12.
Go ahead. I just want to start, and I want to add, even before you get into the contract, I think you're compelled to look at fully insured versus self-funding as just overall. And when you look at your state taxes and you look at trend over time, and that widening scale over 5 years, you're compelled to tell your client the difference and the differences between the superior model of self-funded and fully insured. But from a contract basis, as you move in from 12-12, and let's say we're at 12-15, I would say from a pricing perspective, it's more about concept and money that you can save from self-funded than fully insured. We see a lot of 12-15 contracts that come self-funded from fully insured that run on a 50% loss ratio, and clients save several $100,000 the first year.
I think it's important to point out, too, with all the carriers up here, they have different thresholds of what they'll go down to as far as employee lives. I think there's one up here that only goes down to 100, one to 50. We actually go down to 10 lives, and we have this newer product. It's underwritten individually, and most states, in most states that are passing legislation for self-funded clients, are making sure that those contracts are not 12-12. So when you're dealing with a smaller employer, say a 35-life employer, which we're seeing a lot of these days, it's a 12-21, and it's mandatory new and renewal. So that is something that we think is really the only way to go on that size group. Now, if you're dealing with 50 and up, you're dealing with a more sophisticated buyer, and that smaller employer is looking for something that more resembles a fully insured looking product, or they fund to the max.
Anyone down at this end of the table have any last comments?
Are we allowed to disagree with other panel members?
Absolutely. That's what I want. In fact,
No,
I want to see somebody throwing down
All right,
here
Peter.
at the cocktail reception.
I'm already scared of her. Don't. I actually agree with Chris on just about everything except the savvy buyer thing. In our experience, and we go down to 15 lives and have for quite some time. I almost would say that savvy's not the right term, but the smaller the buyer, the more they care about their money. And we've had great success in the small group market over the years because you're dealing with the owner, the decision maker. I say the producers, the brokers, the TPAs are dealing with the decision makers and the owners, and they know where every dollar is spent, and they care where every dollar is spent. The larger the group, you get further away from the ultimate decision maker. You're dealing with somebody in the C-suite, the CFO, or the risk manager, or whatever. So just a small point, Chris. But
No, I totally agree.
Yeah, I will add to, I think that's why I keep saying the 12-12 first year is not the best way to go. I mean, you can go 12-12 with, terminal liability, some protection for the client, but to sell, how do you get competitive the following year? I mean, Jonathan said 23% on the average is going to be the contract change. And then you're going to have trend, okay? And I don't know what the deductible may be, but it's somewhere around 12-15% on top. So it's almost like avoidance. We sell the 12-12 because it's easy to show that that's the reason, that should never be the reason why they were self-funded. I guess if that is the reason why they were self-funded, they probably won't stay self-funded because it's going to be hard to maintain that. They weren't self-funded because they fully understand, they have the flexibility, they're providing coverage that their employees need. So there is a benefit, incredible benefit for their employees. But that 35%, I mean, trying to be competitive year two, and that is exactly what happens. As you can probably tell by now, I'm an underwriter. So eggs, tomatoes, whatever you may have. So it's hard to sell the second year because what happens, people want us to be competitive. If your account does not have any claims, somehow we're only going to be able to sell that contract change or maybe just the trend or something. So we're creating a deficiency year two. So then at one point or another, it's going to catch up. And one thing that we want to do as underwriters is to be steady in a market. You don't want to have peaks and valleys. And that's why, if we could sell 24-12s year one, I mean, what we're trying to do is to give you a price a little more than 12-12, so the hit may not be 23% the following year. For contract change, maybe only 12 or 14. Because it's the competitiveness. I'm as good as the guy next to me, right? I mean, we're all competitive in the marketplace. But it's, from an underwriting perspective, year two is where the challenge comes to play.
And I know we have a question in the back, but just to follow up with that real quick. So if you're coming from a fully insured to or even, so it's your first year of self-funding and you're eschewing the idea of a 12-12, so you want to go to a 12-15 or whatever. Is it true or is it not true that from an underwriting standpoint, the liability in year one, particularly coming from a fully insured plan, is significantly less for you as a carrier, and therefore your rates and your factors should be reflective of that?
Yes, it is. But does the client understand that year two, that 23% is automatic? I understand.
Why is that? And I ask that question because what happens? Our clients are spending 35% less than the national average. We're averaging increases of 1.3% over the last year.
But it's not 1 year.
Why is that an automatic thing?
Is it a first year savings, or are we talking about a?
It's the past 7 years. We've been doing that. Look at it now. We're having a fight. See that?
We're having a discussion.
Yeah, we watch the light behind you. Wouldn't that be cool to see Kurt go right off the back of the stage?
From an underwriting perspective, it's easy. I mean, you're going to see 9 months of claims, therefore you're going to have a reduced price first year on a 12-12 basis.
I've had an argument with almost every one of you people on this panel about this exact issue, about why is there an automatic
But year
thing?
two, you're going to have a fully mature contract, therefore you're going to see 12 months of claims. Now, there's a question of, are you going to see consistently the same outcome of claims from year to year? No, absolutely not. And that's why the panel has suggested for your CFO to actually budget to the max, because you are going to have those peaks and valleys every 5 to 7 years.
Tom, the real answer is it's the American Academy of Actuaries that say that's what the relative value is. But I will tell you, I think everybody at this table will tell you, I haven't gotten 22% for that contract for a long time, especially when you're sending my quotes out to these other people, because we beat each other up.
Yeah. All I can tell you is that our clients are averaging 1.3% a year, and they're spending 35% less than national averages, and these people should be rewarded for that. There's a question in the back.
Yeah, mine isn't so much a question as a comment about the client who had a question on their CFO. I would tell you that budgeting to the maximum year after year could create some significant accounting liabilities with the IRS if you are intending to write off those dollars as a liability. If that's beyond what your true reserve is for a run-out claim, I question how you were booking that. Also, I would really question if you are passing along increases to the employees and their dependents in the form of maximum premium increases each year. I know there's very significant rules and regulations about those dependent contributions being spent on dependent claims and not just booking as assets into your employer account. And then finally, along that same line, if you are a grandfathered plan, and I know there's very few still in the room, but if you're measuring your employer versus employee contributions and making sure that you're not going over that 5% violation, again, I think it's really important how you schedule those maximum claim liabilities. And can you, in fact, truly pass on an increase to the employees if you, the employer, are booking more and more dollars into your general asset account each year?
That wasn't necessarily a question, but you got your interest. All right, I do have something I do want to ask about. I'm sorry, is there anyone else right now who has a question? All right, let's keep going down there.
Thanks. Yeah, I had a question. As the markets continue to mature and we see more and more refunding contracts versus captives, I'm curious your perspective on what you see in the future in that regard. And then I'm also curious about what you're seeing in various states from the insurance commissioner's offices questioning the specific stop loss limits, and are they too low so that we are, quote unquote, a fully insured self-funded plan, therefore subject to state tax?
Anyone want to take a gander at that?
I can certainly address the specific part of it at the end of your question, and it's been an ongoing issue with the NAIC for as long as I can remember. Their first Model Stop Loss Act, way back in the 90s, at some point, did reference a minimum spec. Very few states, I think something like 9, you might know, Tom, but like 9 states adopted it, and I think the minimum spec back then was, I think it was initially 10, might have moved to 20 at some point, but now they're working on, or I think they've actually published more model stop loss regulation, and they're trying to inch those specific deductibles upward. For some reason, the states don't tend to follow the NAIC as much as you would think they do, or they would, but and that's a blessing for us. But we are seeing a lot of individual states really push for higher specific deductibles. California at one point was pushing for something upwards of $100,000, settled on something far less, but still something far more than the NAIC was recommending. And there are other states that have done the same thing. So it's their way of regulating the self-insured plan in the only way that they can, and that's through the stop-loss insurance.
I think some of it is happening because of the less than 50 and 100 lives by 2016, employer groups going to exchanges and having the rate compression in various states. I think that's one way of the government to regulate, if there's a revenue loss, right, if people go self-funded instead of going to exchanges. So I think that's one way of government regulating that. We've been regulated all along with assessments. Some of the assessments supposed to go away now with exchanges, because assessments were, that's something that stop-loss carriers paid all along, and we paid it to fund the uninsured populations in various states. Well, as the uninsured population is supposed to go away with exchanges, why are there assessments still? But now they changed names. Now they call them, in some, vaccination assessments. So I think that's just one way of government trying to regulate that. And I think as disparity between carriers and exchanges become more evident in the future, and there will be a shortfall. We anticipate will be a shortfall, as does the government with the transitional reinsurance. I think there will be even more scrutiny in a small group market, and although my colleagues play in that market a lot more than I, it is something that we all trying to defend self-funded for, because it doesn't matter how small you are, right? If you can be self-funded, you should have the right to be self-funded. So even though some of us, like our company, just chooses to, we all have a sweet spot. Our sweet spot is a little more than 100 lives. So it's a choice, but we're still going to stick together when it comes to defending self-funding opportunities.
I'm sorry, I didn't.
What was the first part? His first part. Captives and
Yeah, the captives.
What was the first part? What was your first question?
Retros.
Future of captives and then contracts, you said?
Refunding contracts versus captives, and for smaller employers, which is, in your opinion, what is the better way to go?
Yeah, I think there's a lot of buzz in the industry about captives, and for our company in particular, we've had a decided interest in that. We think it's a tremendous vehicle to get groups from fully insured to self-funding with reduced volatility and enjoy all the great things about self-funding that Tom provides. Our program, we've basically seen an explosion in over 130 groups in 18 months in that environment. And I think it's worth a look if your client is the right fit. In particular, the wellness and cost containment component of captives and what that does. And every captive program is different, but if they have taken a decided interest in working with their employees to instill a certain environment, I think a captive can be a good fit. I didn't get the second half of your question, but.
I would just add to that, if the interest in captives is great, we actually administer some captives and participate in risk on captives for smaller employers. And obviously they set their own rules, but I think anybody that thinks that it costs less to be in a captive is mistaken. It's usually, in my opinion, on the premium side, 15 to 18% more expensive, and it needs to be well defined how these employers work together, because if somebody has a bad year, it can, it's just like your neighbor not painting his house for 25 years and you keep yours up, you're not going to like him very much. So you have to make sure that there's well defined in the bylaws of that captive how it works.
And with Optum, we currently are not doing any captives. I don't know, since we're not doing them, I don't know a ton about them, but I would say that there's certain groups out there, and I think everybody has seen those groups that are self-funded, that they don't know what a specific is, they don't know what their aggregate is, and to talk about captives, they still probably even know less on that, so they have to be maybe currently using a captive through a P&C, that'd probably be a good fit, but Optum, we do have a refund product that will provide cash back to the employer group if they have a good claims year, so.
Yeah, just one more point. I agree with Chris. I mean, the captive environment is generally more expensive than traditional self-funding. And then you need to ask yourself, what does the captive provide you, and is it worth your expense? And also, there are many different captive programs out there from many good insurance companies, all with different parameters, and you owe it to yourself really to educate yourself on what those parameters are, and what are you paying for, and what binds those groups together in a captive. Is it the cost containment? Is it the sell? Is it the pricing? And what's most important to your employer?
Yep. We got a question over here, Ali.
I know the main topic of this university is not going to be the ACA, but I think it's in the back mind of everybody that's here. And the question I have for you, our firm is on path to be subject to the Cadillac tax, which my understanding is going to be assessed to the insurance companies. We are partially self-funded. And so have you given any thought as to how that's going to incorporate into your rate structure?
Ooh, look at a bunch of blank stares, Vic.
I don't
Most-
believe that it's
They're like, what?
affecting us. I mean, it's your plan design. I mean, the richer the plan design, the stamp that sits on top of it will reflect on it. But other than that, we really didn't.
Yeah, I think that's
Look at it
primarily, and not to put this on our host, but I think that's primarily going to be a function of the administrator understanding those Cadillac laws and applying them to their client base. because that's an employer penalty. It's not going to be something that's paid with premium.
We'll take care of it, Vic. Don't worry. No, we're not going to pay it. We're not going to pay it for you. I have a quick question for you, and I wrote this down like 2 weeks ago because it happened 2 weeks ago. There's a new drug on the market called Sovaldi. Everybody familiar with Sovaldi? It treats and cures more than 90% of all hepatitis C patients. Brand new drug. Costs $84,000 a treatment, and it takes several weeks, I think up to 12 weeks of treatment to be effective. But it eradicates hepatitis C in something like 93% of all the patients. It's a category killer, right? I mean, there's nobody who has Hep C anymore is going to get anything other than Sovaldi, and it costs a tremendous amount of money. In addition to that, there are 3.2 million hepatitis C patients out there. So the cost of this is potentially astronomical to our industry. How do you deal with that? When something new comes up, is it from an underwriting standpoint, from a carrier standpoint, what do you do about that?
I want to just quick comment. We actually saw one of these claims already.
Have you?
With the drug. And what's worth noting is that there's a 12-week treatment plan normally, but many times doctors will recommend 2 or 3 treatment plans in the same year, which of course we're not talking $84,000 a month for 3 months. We're talking about that on an annual basis. So potentially $600,000, $700,000, $800,000 claim. I think it's a relatively new phenomenon, something we're just starting to see. And just like a hemophiliac claim, as Chris mentioned before, it will be treated the same way. From an underwriting standpoint, that's a risk that we would take very seriously and probably establish laser at renewal.
You know, the other thing is in all self-funded plans, you can treat that in your document by partially excluding it or limiting the co-pays the plan pays, things like that. I know nobody wants to hear that, but that's the reality.
We're waiting for ELAB to develop a program on that, by the way. That was
Yeah.
it.
That's what I wanted to
All right,
say.
Kurt, you go.
Yeah, you just need to bring some people to manage it because it's our problem. It's not just the stop loss, right? If you have a $200,000 to $300,000 or $1 million deductible, you're going to eat a lot of that cost on an annual basis. So, and I think the reason why your loss ratios are running so well with Cypress is because they do that. They bring specific vendors to manage those costs. We've been looking for the silver bullet. I mean, specialty drugs are going to be part of the ongoing trend increase. We've suffered, we've actually had the success of running less than trend for the last 2 years. Last year was probably the first year that actually trends went up. But the reason for the trend going up is the specialty drugs. It's the medication that is being used for multiple purposes, and for one purpose is $10,000 a dosage, for another is $100,000, and you can't argue with that. But we haven't found anybody who has a silver bullet that will actually negotiate better prices with us. There are people that manage hemophiliacs. Yeah, they'll make the experience better, and hopefully, the patient will go through a better protocol, but nobody is willing to negotiate the prices. So we keep calling, and if we find it, you'll be the first to know, because we're hoping, being a large carrier, we can bring that value proposition to you.
One thing I'll add too is that, as probably a lot of you know, but there's new treatments and new drugs and new something coming along fairly frequently. So as these come along, that's fairly new, that it's not as if all of a sudden when that comes out we say, okay, our premiums go up by 0.5% or 1%. It's really just something else that as cases come in, that everybody up here, their underwriters are going to be looking for those, and that maybe in the past where if we saw a Hep C on a claim report, maybe we would think not a big deal. Now we're not going to think it's not a big deal anymore, because the question is going to be, what treatment plan are they on? So there's new stuff coming every day, and a lot of this stuff is brand new and very expensive. So it's just another thing that we'll be looking out for, and the questions will be asked of what's the treatment plan for this Hep C person.
And I guess it's good to point out, as long as I've been in this business, and probably as long as this business will exist, is that the two most catastrophic claims that you're going to get on your plan are accidents and premature infants. And we haven't really talked about any of that today, but those are the two highest cost types of diagnoses you're going to get.
Tom, we've actually had one of these hemophiliac, or a hepatitis C claims in progress right now. It's trending towards $1 million.
I was just going to ask how much it is. $1 million.
It's because they're going to have more than one round, is what the case management notes are telling us. But this is it's more or less of a maintenance type approach to the disease, and it's not unlike kidney dialysis in that respect. So when we're talking about lasers and the opportunities for lasers to hit or not hit, I mean, this is just one more condition that demonstrates the value of a contract that guarantees not to laser, because there's no question whether this is going to hit. I mean, it's black and white, just like dialysis. We see 30 months of dialysis claims. We know on a monthly basis what that's going to cost. It's not a what if, it's a certainty. So you can count on that being a fixed expense. Again, it just demonstrates the value of a contract, a stop-loss policy that guarantees not to laser at renewal.
Tom.
Okay.